Welcome to the deep dive. You're here because, let's face it, you need knowledge fast, you need it thorough, and you definitely don't have time to sift through stacks of dense research reports.
Right. So we've done the sifting for you. We've cracked open the analysis on USA Rare Earth Inc. That's ticker USR.
And this one, well, this feels important.
It really is. I'd say this is one of the most critical and, frankly, maybe one of the riskiest deep dives we've tackled this year. Our mission today is to really distill what USR is about. Their core business, the leadership change, the financials, which are very forward-looking, and, crucially, the huge geopolitical risks tied to this company.
Yeah, and it's currently trading around, what, $27.73 as of October 17th, 2025?
Correct.
The stakes feel incredibly high with this one. It's not just another stock pick. It feels like a direct play on America's industrial security. So here's the big question, the hook. Can a company with zero revenue right now, based out of Oklahoma and Texas, actually secure America's tech and military independence? And in doing that, could it deliver an intrinsic value that some reports suggest is nearly triple its current share price?
The potential prize is, well, immense. But the reports also make it crystal clear that the path there is, let's call it a strategic high-wire act, loaded with execution risk.
Okay, let's unpack this tightrope walk. Part 1. Fundamentals and financing.
All right.
Let's dive straight in. Chapter 1, business analysis. So USR's core strategy, they call it mine to magnet. What does that actually mean?
It means they want to build the whole thing, soup to nuts, right here in the U.S., a fully domestic, vertically integrated rare earth supply chain. And that's a direct challenge to the current situation.
Because right now it's mostly China, isn't it?
Oh, overwhelmingly. China controls roughly 90%, maybe even more, of the processing and refining needed to turn raw, rare earth ores into usable materials, especially magnets. USR's entire reason for being is basically to break that dependency.
Okay, so where will their money come from eventually, since, as you said, it's zero right now?
Right, good point. It's all future-focused. The main driver is expected to be specialized sintered magnets, NdFeB magnets, or neomagnets from their new facility in Stillwater, Oklahoma. Phase 1 there is targeting about 1,200 tons per year by 2026. They'll also likely sell some surplus minerals from their mine deposit down the line.
And they didn't start completely from zero on the factory side, did they? There was that acquisition.
Correct. That acquisition of Less Common Metals, LCM, back in September 2025 was, frankly, transformative. It gives them some immediate, though pretty small, revenue, but much more importantly, it gives them instant operational know-how and, crucially, existing supply chain links for raw materials outside of China.
Ah, so that helps bridge the gap until their own mine is running. It de-risks that factory startup quite a bit.
Significantly, yeah. Now, what's really fascinating and what makes USAR different from, say, MP materials is the type of rare earths they have. Their deposit, Round Top, is unusually rich in heavy rare earth elements HREs. We're talking dysprosium, D, and terbium, Tavy.
Okay, break that down for us. Why should you, listening right now, care about heavy versus light rare earths? LREs versus HREs?
Because it's all about application. LREs, the light ones, are common in things like your phone, standard EV motors, but HREs, they're essential for stuff that gets really hot or needs extreme performance. Think high-end defense systems, F-35 components, missile guidance, or the absolute top-tier, high-efficiency EV motors and wind turbines that operate under stress. Dysprosium and terbium basically stop these powerful magnets from losing their magnetism at high temperatures.
So USR isn't really going head-to-head with the MP materials of the world?
Not directly, no. They're building the other critical piece needed for a truly independent U.S. supply chain, the heavy side. It's about defense and high-performance industrial applications.
Got it. So their value proposition isn't just magnets, it's supply chain security. It's stability against, well, geopolitical blackmail, essentially.
That's the core of it. And that necessity is what's driving these huge market tailwinds. You know, EVs, wind power, defense spending. The global market for just rare earth magnets is projected to explode. Something like $13.6 billion this year, potentially soaring past $40 billion by 2034.
Wow. And if they get the mining part right, what's the advantage there?
The geology. That's potentially their ace in the hole. Round Top specific rock formation might allow for low-cost heap leaching.
Heap leaching, like they use for gold sometimes.
Exactly like that. Instead of a hugely complex multi-billion-dollar chemical plant, you can, in theory, spray chemicals over large piles of crushed ore to dissolve out the valuable elements. It's projected to be much cheaper, much simpler. If it works at scale for these particular minerals, it could make Round Top one of the lowest cost rare earth sources on the planet.
If it works. That seems to be the recurring theme here.
It absolutely is, which leads us perfectly into the next part.
Right. Chapter 2. Management evaluation. Who are the people trying to pull this off? Because there was a big change recently.
A very significant one. The strategic CEO shift. They moved from Joshua Ballard, who handled the finance side, the SPAC merger, the whole go public phase, to Barbara Humpton in October 2025, just now.
And Barbara Humpton, she comes with a heavy-hitting resume, doesn't she?
She really does. This move signals a major pivot from finance to execution. This is the go-build phase now. Humpton was president and CEO of Siemens USA. Before that, senior roles at Lockheed Martin and Booz Allen Hamilton.
Okay, so deep industrial experience plus strong defense and government connections. That sounds like exactly what they need right now.
Precisely. It brings immediate credibility, especially for navigating things like Department of Defense contracts and large-scale industrial project management. They need someone who knows how to build things and deal with Washington.
And she's inheriting a pretty bold strategy, this parallel path development.
Yes, bold is one word for it, risky is another. They're spending serious money, $60 million capex, just this half, to build the Stillwater magnet factory first. They plan to run it initially using materials bought from third parties while they're simultaneously developing the Round Top mine itself.
So get the factory running fast, generate some cash flow sooner, but you're dependent on outside suppliers until your own mine comes online. That feels precarious.
It is. It's high stakes, but you have to look at the potential prize to understand why they're taking that risk. Remember that 2019 preliminary economic assessment, the PEA, for the Round Top mine?
Vaguely. What did it say?
Well, look, it's speculative and needs updating, but the numbers were just eye-watering. It projected a pre-tax internal rate of return, the IRR, of 70%.
70%.
70. And a payback period of just 1.4 years. Now, again, grain of salt, it's old data, but it shows the sheer economic potential locked in that geology if they can get it out. That's why they're willing to risk the parallel path.
Okay, that kind of potential return certainly justifies some risk. Which takes us to the money. Chapter 3. Financial analysis. Let's talk dollars and cents, or rather the lack thereof for now.
And we have to start with the pre-revenue reality. Let's be absolutely clear. Current revenue is zero. All their margins are negative. They posted an $8.8 million operating loss in Q2 2025. It's a development stage company, pure and simple, but one with a multi-billion-dollar market cap attached.
Right, so the whole financial narrative is future tense. Yet analysts are putting out some pretty specific forecasts. What are they predicting?
They're predicting rapid growth once things get going. Forecasts are around $45.88 million for fiscal 26, jumping quickly to $179.39 million by fiscal 27.
Okay, ambitious. But are they burning through cash too fast? How's their liquidity right now?
Actually, their short-term position is quite strong. They reported $128.1 million in cash. And check this out. Their current ratio is 15.1.
It's 15.
Yeah.
It's really high.
Exceptionally high. It means they have over 15 times the short-term assets needed to cover their short-term debts. So they have a decent runway, financially speaking, to get that Stillwater factory built without hitting the panic button immediately.
Okay, that's reassuring. But let's tackle the valuation elephant in the room. With no earnings, PE is useless. What about forward multiples?
Yeah, good question. Looking forward, based on those 2027 sales estimates, the forward enterprise value to sales multiple is hovering around 15.0x.
15 times future sales. That sounds rich.
It is high. Very high. It tells you the market has already priced in a lot of success, a lot of optimism into that current $2.7 billion market cap.
So how do analysts even attempt to value this thing fundamentally?
They have to turn to intrinsic value models, mainly the discounted cash flow, or DCF, trying to figure out what all those projected future cash flows are worth in today's dollars.
And what does the DCF model spit out? This is where it gets interesting, right?
This is where it gets really interesting. Assuming they execute almost perfectly, the analyst models estimate a theoretical intrinsic value somewhere in the range of $79.40 to $81.09 per share.
Whoa, hang on. $80. We just said it's trading at $27. How on earth do you get to 80? That seems astronomical.
It does, doesn't it? But you have to look at the assumptions baked into that $80 figure.
The fine print.
Exactly. That valuation relies heavily on things like a very high discount rate, the WACC, or weighted average cost of capital, set at 14% to reflect the huge risk. And it also assumes a pretty optimistic long-term growth rate of 6% beyond the initial forecast period.
So the enormous gap between that $80 theoretical value and the $27 reality, that's basically the market pricing in the massive chance they don't execute perfectly.
Precisely. That $50 plus difference is the execution risk premium, plain and simple.
Part 2, market perception and risk.
Okay.
The valuation disconnect leads us right into Chapter 4, market sentiment. And this is where things get a bit wild, analytically speaking. Well, look at the analyst ratings versus their price targets. The consensus rating is actually strong buy. 4 out of 5 analysts say buy.
Okay, bullish.
But the average 12-month price target from those same analysts is somewhere between $24.25 and $26, which is actually below the current share price of $27.73.
That is quite the divergence. What does that tell you?
It tells me the market's excitement, probably fueled by geopolitical news and the whole national security angle, has run ahead of what analysts think is achievable in the next year. The momentum has outpaced the near-term fundamentals.
That makes sense. It really behaves like a headline stock. Any whisper about U.S.-China tensions, potential government funding, DoD interest, White House meetings, boom, the stock reacts, often dramatically.
And technically, the momentum has been undeniably strong.
Yeah.
It's way above its 50-day moving average, which is around $19. It's up over 70% in just the last month alone.
Yeah, the chart looks pretty parabolic recently. And you also mentioned short interest.
Right. It's moderately high, somewhere between 7% and 9%. That adds another layer of volatility. If good news hits, those shorts might be forced to cover, potentially squeezing the price even higher.
A potential short squeeze candidate adds more fuel to the fire.
Okay, let's look at who actually owns this stock. Chapter 5, ownership structure. Is it just type traders?
Not primarily, no. Institutional ownership is definitely building. It's somewhere between 14% and maybe up to 31%, depending on the source. And crucially, it's dominated by investors who understand and tolerate high risk. Think sophisticated funds like Alieska Investment Group. They hold a chunky 9.12% stake.
So it's more like venture capital playing in the public markets.
That's a very good way to put it, yeah.
Now, insider holdings are also pretty high, right? Up near 46%, which normally aligns insiders with shareholders.
It does, which is generally seen as positive. Management has skin in the game.
But we absolutely have to talk about that huge insider sale recently.
Yeah.
Director Michael Blitzer unloaded shares worth roughly $32.9 million. That's not insignificant.
No, it's definitely not. $33 million is a massive sale. How does the market typically read something like that?
Almost always negatively. It's hard to paint a sale of that size in a positive light, even if the official reason given is, portfolio diversification or something.
Your perception matters. And when you combine that large sale with the fact that ownership is quite concentrated among a few large, sophisticated holders.
It creates concentration risk.
Exactly. High volatility risk.
Yeah.
If just one or two of those big funds decide to trim their position or head for the exit, the stock price could take a very steep, very fast hit. There isn't necessarily a deep pool of buyers to absorb that kind of selling pressure quickly.
Okay, this paints a complex picture. Let's try to structure it with Chapter 6. Risk assessment using a SWOT analysis, strengths, weaknesses, opportunities, threats.
Good idea. Let's start internal. What are the core strengths?
Well, number one has to be control of that round top deposit. It's considered world-class, especially for those critical HREs.
Agreed. And the potential for that low-cost heap bleaching process is a unique strength.
Yeah.
Plus, the new CEO, Hunton, brings immense credibility. And as we discussed, their current balance sheet liquidity is strong.
Okay, now the internal weaknesses. What holds them back?
The biggest one is obvious. They're pre-revenue. They have no established business yet. Then there's the massive execution risk we keep mentioning. Trying to build both the mine and the factory at the same time is incredibly complex. High cash burn rate until revenue starts. And that dependence on third-party feedstock in the interim is a definite vulnerability.
All right, now let's look outside the company. Opportunities.
The opportunities are huge, driven by geopolitics. There's a very high probability, many analysts think, of receiving significant non-dilutive government funding. Think grants, loans, or guaranteed purchase contracts, especially from the Department of Defense.
Because it's seen as vital for national security.
Precisely. Plus, you have the explosive growth in the EV and defense markets, providing guaranteed long-term demand for their magnets if they can produce them.
And the flip side, external threats.
The biggest geopolitical threat is Chinese market manipulation. China has the capacity to flood the market and drive down rare earth prices specifically to make Western projects like USAR economically unviable. They've done similar things before.
A deliberate strategy to maintain control.
Potentially, yes. Beyond that, you have the standard but very real risks for any huge project like this. Construction delays, unexpected cost overruns, and almost certainly future shareholder dilution. Building out that round top mine is going to cost hundreds of millions, likely requiring them to issue more stock down the road.
And what about broader economic factors? Inflation, interest rates.
Yeah, the macro environment matters. High inflation and high interest rates make everything more expensive: construction, borrowing costs.
What?
It also increases that WACC discount rate we talked about, which lowers the calculated intrinsic value.
But there's a potential upside from geopolitics too, right? Like tariffs.
Absolutely. If the U.S. were to impose targeted tariffs specifically on Chinese rare earth magnets or processed materials, well, that would be a massive tailwind for USR. It would instantly make their domestic production much more competitive. So, geopolitics cuts both ways here.
Okay, we've covered a lot of ground. Let's bring it all together in Chapter 7. Conclusion? Let's synthesize the bull case one last time. Why would you bet on USR?
The bull case is essentially this. USR is a pure-play investment in strategic U.S. industrial policy. They have a unique, globally significant HRE asset. They have a highly credible new CEO specifically chosen for execution. They're aiming to become vertically integrated into a market high-performance magnets that is guaranteed to grow massively, driven by EVs, renewables, and defense. And the entire effort has strong, arguably essential, backing from a national security perspective.
Makes sense. Now give us the cold water, the bear case.
The bear case is equally straightforward. This is a highly speculative venture. It requires near-flawless execution of two incredibly complex, capital-guzzling projects simultaneously. The current $27 stock price already assumes a significant amount of success, leaving very little room for error or delays. And ultimately, its fate is heavily tied to huge financial uncertainties and geopolitical forces completely outside of their control.
So circling back to that $80 theoretical value versus the $27 market price.
That gap is the story. It's the market demanding a huge premium for taking on that mountain of risk. Investing in USR today isn't like buying a blue chip.
It's much more like.
It's a venture capital style bet placed in the public markets. You're betting on Barbara Humpton and her team's ability to navigate the minefield, technical, financial, geopolitical, and actually deliver on this incredibly ambitious vision.
A bet on execution against very long odds, but with a potentially huge payoff.
Exactly. And before we wrap up, here's a final thought, maybe a provocative one for you to chew on. Given how critical this capability is for national security, what happens to USR's valuation, to that risk profile, if the U.S. government effectively decides it cannot fail? What if they step in with, say, a guaranteed price floor for USR's magnets, or a massive multi-year, non-dilutive loan package to ensure the mine gets built?
That would fundamentally change the calculation, wouldn't it? It shifts it from a purely commercial risk to something closer to a state-backed strategic asset.
It certainly could. Something to consider.
All right, that concludes our deep dive into the complex world of USA rare earth. A fascinating high-stakes story. If you found this analysis valuable, please do like and subscribe to Stock Analytics AI. It really helps us out. And remember, for just $4.99 a month, you get access to our full playlist. That's 500 deep dive videos covering every single stock in the S&P 500. Plus, coming up next, exclusively for our members, we're tackling the NASDAQ 100. And members, don't forget you can request deep dives on specific stocks. Just drop the ticker symbol in the comments section and we'll get working on it for you.
We will.
Finally, the necessary disclaimer. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice.
Please always do your own research, or better yet, consult with a qualified financial advisor before making any investment decisions.
Thanks for diving deep with us today. We'll see you on the next one.